Before we dive into anything today, let me start with something very important. What you're about to see might change the way you think about Opendoor and the entire real estate tech sector. The numbers I'm going to show you, the market behavior I'm about to explain, and the actions from big institutions that most retail traders never notice. All of this paints a very different picture than what you might assume from just looking at today's red chart. If you've ever sold too early, bought too late, panicked because of a sudden drop, or felt like the market was moving against you for no logical reason, then you need to watch this entire video. Because today's movement in Opendoor is a perfect example of how data, algorithms, and institutional trading can create a story very different from what you see on the surface. And trust me, once you understand what's actually happening behind the scenes, you'll never look at this stock the same way again. So stick around, hit that thumbs up button to support the channel, and let's get straight into it. Before going forward, quick disclaimer. This video is for educational and informational purposes only. Nothing I say is financial advice. Always do your own research before making any investment decisions. Now, let's talk about Opendoor. Today, the stock is down 5.84%, hitting a low of 7.22 and a high of 7.53, with about 22 million shares traded so far. That's relatively low volume, especially when you consider the volatility we're seeing. And today is honestly a strange day because heading into this week, most investors were fairly optimistic. We had a steady flow of positive economic data hinting at the possibility of a rate cut, which usually boosts growth stocks like Opendoor. Earlier this morning, we saw two key reports drop, the S&P Global Report and the ISM Manufacturing Report, and it's important to understand the difference between these two. S&P Global includes small cap, mid cap, and large cap companies, giving a broad picture of the economy. ISM, on the other hand, focuses only on mid and large cap companies. This morning, small caps performed especially well, coming in at 52.2 versus a forecast of 51.9, which signals expansion. That's a very good sign because it shows that the small business sector is growing and not signaling any major warning signs that would concern the Fed. However, the Fed's bigger concern right now is consumer spending, not manufacturing strength. And on November 29th, we got data showing U.S. Black Friday online sales hit a record-breaking $11.8 billion, up 9.1% from last year. And while that might sound like great news for the economy, it's actually not the kind of news the Fed wants to see at this moment. Strong consumer spending makes it harder for the Fed to justify rate cuts. They want consumer and labor data to be slightly weaker, not collapsing, not recession-level bad, but just weak enough to support a rate cut without overheating the economy. Right now, the odds of a 25 basis point cut at the upcoming December 10th meeting sit at about 86.4%. But my personal belief is that this number is outdated. It hasn't moved in a while, and once it updates, I expect it to fall closer to 60% or maybe 70% at best. That's not necessarily terrible, but it's far from a guarantee. Moving back to Opendoor, the company hasn't released any fresh news. No new interviews, no fireside chats, nothing speculative. Even Cass, who usually pops up on social media every now and then, has been unusually quiet. His last tweet simply said, "faster." No context, no hint, nothing. It was posted on November 30th at 12:09 p.m. I'm not sure if he's hinting at execution, spending time with his wife, or dropping a subtle Easter egg to the investor community. Let me know what you think in the comments. Now let's talk about short interest because this part is very interesting. Shorts returned 338,000 shares recently. Currently, 13.96% of the free float is shorted, which equals about 109.21 million shares. Earlier in the month, November 13th, short interest was around 23 to 24%. But starting around November 24th, short interest dropped sharply. So if you were expecting a short squeeze based on the older data, today's numbers unfortunately don't support that idea anymore. The short score is now 57.4, which is relatively low. For reference, it was 66.6 on November 6th. The higher the score, the higher the squeeze potential. So clearly, the squeeze probability is shrinking. Options flow today shows $3.4 million in calls, 1.04 million in puts, and about 58% of all options traded are bearish. Now, here's where my personal opinion comes in, and I know some people won't agree. But I think we could see buyers come in strong during the second half of the day or even tomorrow. Why? Because the market today reacted to a tweet, not official economic data. And historically, when markets react too strongly to non-official sources, they tend to correct themselves shortly after. Meanwhile, actual economic data has been mostly positive. If the market does shift bullish later today, expect bullish options flow to follow as well. People who understand how options work know that betting against the market can make serious money, but timing is everything. Right now, the market seems to be pricing for further downside, and that aligns with the Elliott Wave technicals. According to the model, we have a pivot point at 7.69. As long as we stay below that, the projected downside could be between 5 and 4.36. Yes, that's extreme, but these models look at momentum, and momentum is leaning bearish. On the bullish side, some forecasts expect Opendoor to reach around $8 by the end of the week. Bears are expecting it to fall below $7.50. Looking at both sides, the frequency of predictions leans slightly more towards the downside, but upside potential is still very much present. Now, here's where things get even more interesting. When you look at secondary market transactions, you notice a pattern. Institutions are buying. And this is why I always tell you, don't panic just because the stock is red. A lot of these movements are artificial, driven by algorithms designed to trigger specific behaviors. Some institutions are selling, of course, but the majority of large transactions are buys. Even shorts returning shares is a bullish indication. So in my opinion, this sell-off is unjustified, and dips like this are opportunities. In the dark pool, transactions over $100,000 are pretty standard today, nothing unusually large. With Opendoor trading at around 724, it's sitting between the pivot and the S1 support level. The next strong target or resistance is 747. If Opendoor can push toward that level, it could create a nice swing trade setup. From a technical standpoint, Opendoor is now below the 50-day moving average, which isn't great. It's hovering around the 10-day moving average at 731, and that level could become important depending on where we close today. Most of today's volume is clearly algorithmic, which explains the strange movement. I'm not here to hype you up or bring you down. I'm simply interpreting the data. And from everything I'm seeing, today looks like artificial suppression, while larger players quietly accumulate shares. Stochastic RSI is neutral, not overbought, not oversold. There are no new analyst ratings, and the only articles linking Opendoor to anything lately have been lumping it in with meme stocks. That debate is still happening. Is Opendoor a meme stock, a momentum stock, or something else? Personally, I see it as a momentum stock. Maybe early this summer it had meme-like behavior, but since then people have grown to trust Cass and the direction he's taking the company. Let me know your thoughts on Opendoor. Are you buying? Are you selling? Where do you think it's heading in the short term? Drop your comments below. I'd love to hear from you.